Hi guys, welcome back. Tesla seems to be getting hotter these days, and I got a request from one of the viewers of our channel, to take a look at Tesla and talk about it a little bit. And we're going to be doing what we usually do here, examine the financials of the company and be extremely objective about what we see. It's not going to be a pump up session as you see in a lot of YouTube channels. This is all about objectivity. So, one of the things that I want to examine before I begin is the social trends. Kind of gives me an idea of what's going on right now. You can expect it to be a little bit less than it was in the previous days, and this is exactly the case. Although the posts and comments on stock tweets are still pretty high and getting higher, generally speaking, like for instance Twitter, seems to be a little bit less of an activity right now. Again, you would kind of expect that it will dissipate a little bit after strong movements. Okay, so the next thing that I want to take a quick look at is I want to see the chart here, and you will see that Tesla has been enjoying insane growth in the last couple of years, really. And that is a thing that can definitely happen with a company, but of course you would like to get Tesla here or maybe here. When we are talking about these levels, like 1,000 here, we need to make sure that we are not overpaying if we're buying a company. And there's one thing to understand. I myself am a big fan of Tesla. I love the cars. For a long while, I was actually thinking of buying a Tesla when I was living in the US, especially. Right now, I'm living in Europe, so it's pretty expensive here when you compare it to the US. And I think that I may actually spend my money in something that makes a little bit more sense at that price range. But back in the US, I was really thinking about buying a Tesla. Now, again, I love the cars, but the company pretty much, and the stock is a completely different thing. And before we begin, I wanted to mention a thing that you may have seen in a lot of YouTube channels that are trying to pump up a stock like Tesla. You see them buying into Tesla and then selling Tesla and then buying again and then selling again. And in between, talking about how great Tesla is and how the stock is undervalued and all that. The thing that you need to ask yourselves is if these people think that the stock is undervalued, why are they exiting the company? I myself have talked about actual undervalued companies like Facebook or Alibaba and have bought into those as the stock price was going down. If the thesis doesn't change, why would you sell when the stock price is down? You should be buying. I mean, if something fundamental about the company doesn't change, why are you selling? And this tells you a lot of things about whether they actually think the company is undervalued or they are actually riding the wave, riding the hype. And you really want to avoid that. You don't want to be riding the hype unless you are trading the company. If you understand that this is the case, this is what you are doing, and you know that you are trying to get some quick money, some quick profit, then do that by all means. But if you are actually looking to buy a company for the long run, then you really need to examine the financials as we do here. And so this is what we're going to be doing next. And to do that, I'm going to jump to my stock analysis module here, which helps a lot with analyzing the numbers here. And you will see that I have all sorts of numbers that can help us here. And this is a work in progress. I'm adding some more key metrics that I want to be having about the company over here in this page. But it already has a lot of things that can actually point us to whether a company is undervalued or not. And you will see that the 1 year highs was at $1,200 almost, so we're down 20% from those highs, the 1 year highs. And currently we're sitting at about almost 1,000 here, right? This is what it closed with, as you can see here. 0.52% higher. And the P ratio, look at this. So the P ratio of the company at some point in 2019 used to actually be negative because the company was losing money. But then the company started making money and now it's pretty positive. However, it's very high. So that's something to bear in mind. Now, the P ratio is not my most important metric, but the price to free cash flow is an important metric that I really take a look at. And this is going to be a factor in our determination of the actual stock price, the price that we are willing to pay, that is, not the market value, not the market price. And the outstanding shares of the company, look at this, 27%, 24% higher. This means that investors over here got massively diluted and their shares lost value because of that, at least intrinsic value. Now the pie is larger, so they hold less of it. And so that's a bad thing to see. And I understand Tesla issuing shares because they can fund themselves with this, especially as the stock price goes higher and higher and people are willing to buy more and more. Now, the 5-year revenue growth and net income growth is on par with each other. That's good. And it's increasing. Don't get me wrong. I mean, the company does seem to be increasing its revenues, net income. They're selling a lot. So let's, however, examine what they are doing in terms of their evaluation here. Because again, the price of the stock and the price of the company are two completely different things. And so we want to make sure that we are getting a deal about both of these things, in both of these things. So we have a handy table here that gives us the averages, the 5-year average, 3-year average, and the last year value. And this is for revenue growth, for example. And you will see that the revenue growth is sitting at similar levels, apart maybe from 2019. But we can likely expect the company to keep growing nicely for the next 5 years. This is a 5-year discounted cash flow model. And so I'm going to go 20, 22, and 24 here for our revenue growth. We still want to be conservative. We don't want these kinds of numbers here because they are still pretty high. And we want to be conservative because we want to be making money. And so we're having a margin of safety here. That's what we are doing. Now, the net income margin, as you'll see again from this breakdown here, has been negative when the company was making money, was losing money, but now it's going back to profitability, and so the company's margins are getting better and better. So I'm gonna use 5, 6, and 7. I'm probably not going to be paying attention to this because I don't think these are going to be happening anytime soon, to tell you the truth. And of course, in your calculations, you can use all sorts of values, but I think this kind of margin does make sense for now. The free cash flow margin, again, it's all over the place, and it used to be negative in some situations. But I think I'm going to go with something like 60, 70, and 80 here. It looks like about 60 or 70% is going to be how much of net income becomes free cash flow. And the annual return that I want to typically be getting out of companies is 13%, just because I can get 10% from an S&P 500 ETF. So if I'm going to invest in a single company, I need to be making some more, right? That makes sense. And so we're going to calculate using these values, and you'll see how far we are from the current price. You'll see why the current price is extremely overvalued in this company. We're paying a lot if we're actually paying $1,000 for this company. And so I would like to see this company significantly cheaper in order for me to enter it. Again, I think it's a fantastic company. I think it will still keep growing. But if I buy today, I'm paying 10 times what they're making in terms of their financials, and that won't change. And even if that does change, why would I pay more for it? It's as if I'm willing to buy a car or a house, let's just say, that's worth let's say $100,000 today. I'm willing to pay $1 million for it today. That's not how it works. I mean, you need to be making money in the process, and in order to be making money, you shouldn't actually rely on the hype alone. You should always rely on the company making enough for the shareholder in order for you to eventually get your money back. Because if this crashes, it will crash hard, and there will be nothing to support it. There will be no underlying financials to support this price. And this is why we are using this very, very handy model here to help us avoid this kind of companies. And again, this could be a potentially nice company to trade, but trading has all sorts of different, very, very different rules. Because in trading, you do have stops. For instance, you could buy this at let's say $1,000, and you have a stop at $950, and you are fine with losing $50 to potentially pocket more in a period of 2 months. But in that case, you are actually trading the ticker symbol and not the company. But as a long-term investor, we are trading the company and not the ticker symbol. And this is why we need to pay attention to financials. And this is what we're doing in this channel. Hopefully you enjoyed the video. Hopefully it helped you a little bit. If it did, please leave a like and subscribe. I'd love to see you around. Eventually I will be giving access to people, to subscribers in this tool. So you may want to stay around by subscribing. You will be one of the first people to know and get access. So thank you for watching the video, and if you did enjoy this one, take a look at this video that I made earlier, and I'm discussing how to invest, how to create a stock portfolio. And I think it will be very, very interesting, a very, very interesting read, regardless of your level. It can give you some ideas. So thank you for watching, and I'll see you in the next video. Bye-bye.